Okay. Hi, everybody. We're going to kick off the afternoon session with panel 3, Product Proliferation and Innovation in Registered Funds. I'm going to pass the mic over to our moderator, Christian Sando, who is an assistant director in the division here, who will then introduce the panelists. Thanks.
Good afternoon. We have the privilege of going after lunch, so hopefully we're able to keep folks awake. When we were prepping for this, Samara asked me what would be my idea of what would be a successful panel. And the answer to that question came when I was talking to Dave just a second ago. And he said, we're going to be so lively you won't get a word in edgewise. And I think that would be a successful panel. So I am Christian Sando. I'm an assistant director in the Disclosure Review and Accounting Office in the division. I've been with the SEC for 29 years and the division for 25. I should also mention that when the directors were talking about the things that they were most fond about, the holiday party, you heard Dahlia mention Sando Claus, one of my other roles. In case you hadn't figured that out. I'm going to pass it to each of the panelists to introduce themselves. Samara Cohen, Dave Nadig, and Gerard O'Reilly. Samara.
Thanks, and I'm so happy to be here. I'm Samara Cohen, the Chief Investment Officer of ETFs and Index at BlackRock.
And I'm Dave Nadig. I'm an independent ETF expert. You can find me at nadig.com, former CEO of ETF.com, and a few other places.
Hi, Gerard O'Reilly, and again, thank you for the invitation. Happy to be here. Co-CEO and co-CIO of Dimensional Fund Advisors.
Okay, so let me, so now that we know who we all are, let me start by addressing the obvious. Much has changed since last year's panels regarding, from a regulatory perspective. We have a new administration. It's been laser focused on curtailing government spending and deregulation, among other things. We have a new chair who's focused on promoting an SEC that embraces and champions innovation, balancing investor protection with promoting capital. And finally, I can say from experience that we continue to see a proliferation of novel products and product innovation in the registered fund space. So in that vein, I am looking forward to discussing product proliferation and innovation in the RIC space. When we think about product innovation, we have seen products seeking to provide all sorts of solutions for different investors trying to get exposure to different things in new or novel ways. Some products seeking to solve for investors' longevity risk, some seeking to provide exposure to different asset classes, some seeking to offer exposure to assets that have been historically available, in other structures or formats, but which now, are seeking to be offered using different structures within the 40 Act regime. So my question to the panel is, how should the industry be thinking about novel products and structures, particularly for average Americans looking to build a nest egg or with other similar long-term goals? Anything in particular to consider? I can open it to the panel, or I can start with one.
So maybe I'll kick us off, and if it's okay, before we dive into all of the excitement, I think, that has characterized the last 6 months, provides some context for how I think broadly about the investment product landscape in the United States. And I think there were so many things I enjoyed about the first panel of the day, the Forever Young panel, but especially the final comment about the role of funds in capital markets. It is really funds and fund structures that allow for the suppliers of capital or savers. I mean, that's half of the capital markets. When we think about markets, it's how consumers of capital, governments, countries, meet suppliers of capital and savers, and fund structures are a huge enabler and a critical growth driver of markets. And when I think about the major moments that have formed where U.S. markets are today, For me, it's very important to start with the, kind of financial crisis and post-crisis period, and I think you'll hear tones of our conversation that very much connect to the earlier conversation on crypto and tokenization. Amar Kuchinad from Copper, who spoke, and I were both at Goldman Sachs on Lehman Sunday in 2008. Which was a kind of watershed period in markets that kicked off a lot of reform around the world that largely created conditions that we operate in today, particularly around price transparency, exchange, multilateral tradability, central clearing, and the broad distribution of risk in the system. And those moments created huge tailwinds for investment products, most notably ETFs. All of that regulation and reform really supported anything that had transparency, lent itself to exchange tradability and ETFs. That's moment number one. Moment number two, which I credit the commission with and the division with, of course, was the ETF rule in 2019. And it was so important to kind of have that conversation around how exemptive relief allows for flexibility and adaptation to new market parameters up to a point when you need to actually make industrialized change, which is what the ETF rule did. And of course, that lent us into what I would call the kind of era of ETF innovation, making it easier to launch active products, et cetera. And then the last moment that I think is important is more of a kind of conditions in the market environment. And while the first panel did discuss the kind of how public equity markets have become smaller, I think the issue facing investors is much broader and has been a really outgrowth of the investment environment that we experienced in 2022 when you had this historic experience of bond markets and equity markets going down together. In 2023, you had some time to figure out how to be defensive because all of a sudden you were earning some interest rate on your cash. But once you actually had to think about reinvestment risk and long-term investment outcomes, how to construct a portfolio and what the new kind of default asset allocation should be for a long-term investor. Was it 60-40? Was it something else? Really lends us to how do investors get access to the rest of markets beyond public equities and public, although we can debate how public the bond market has ever been. But the conversation now around, how you think about product proliferation, I think should be framed in how investors get access to those diversifying strategies, downside reducing strategies, income producing strategies that they feel more urgency around as a result of the market environment that we're in.
Yeah, I would just chime in and say the product proliferation sort of is in two components. One is a complexity component, and one is sort of an access component. And there's no question that 611, the ETF rule, really opened up the access window for all sorts of new strategies. You combine that with the clarification of derivatives rules, and what we've seen is, yes, a lot of interesting, useful new products come to market. They open up new corners of investing, but we've also seen a rise in what I call package trades, right? Complex, multi-legged, derivatives-based products, which are designed to create sort of a unique pattern of returns that, frankly, very few people have ever asked for, right? So it's a lot of people making things because they can, not because there's any necessary reason to put these things in a portfolio. There's no academic justification why you need variable leverage income strategies on single stocks, right? There's no academic background for any of this stuff. So we're in this bizarre position where we've got some great stuff that's finally coming to market, and I'd put in there things like getting access to spot Bitcoin, right? I mean, opening up these big new asset classes, that's awesome. But at the same time, we've let slide through an enormous amount of products targeted at retail investors, to be very clear, that are more complex than anything I ever traded when I sat on a trading desk professionally. That's a bizarre situation we find ourselves in.
All good comments, and kind of building on what Dave and Samara have said. There's probably two themes I think or maybe three that are important for both managers, but then also You mentioned people saving for retirement when they're assessing the proliferation of new products that are available out there. And when I think about it, at least, one is when you have kind of a novel product, does it drive efficiency into the system? So Samara, you hinted at this and kind of built on it with respect to ETFs, that when you think about longevity of a structure or of an investment strategy, if it can do the same for less, then that probably has the ability to have some sort of longevity associated with it. And we've seen that very much with ETFs, but on some of Samara's comments with respect to you're a financial professional, you want to implement a model portfolio. The number of tools that you have to implement a model portfolio with ETFs now at kind of close to zero explicit costs dwarfs the number of tools that you have to implement a mutual fund model, right? So it's kind of that those types of efficiencies are not just from the vehicle itself, but what can be done by either financial professionals or the end investor with the vehicle that I think drives longevity into a particular innovation. So I think efficiency. So if you see some things in the marketplace, they may start small, but I always think about what can that do to help this strategy be more efficient. And that actually comes with respect to tax efficiency as well, which has become ever more important for financial professionals and end investors. The second one, I think, is, and I agree with this, new regulation. As a manager, when you're looking at new regulation, the thing that you're thinking about is, okay, how can I use that to the benefit of end investors? And I think Rule 6C11, just to kind of, since it was mentioned earlier on, some of the work that can be done around custom baskets, which effectively drive down implementation costs as close to zero as you're possibly going to get in a commingled strategy, is pretty cool. And that's some types of innovation that lead to efficiency from regulation. The last part, though, I think about when, and I think, Dave, this is what you're alluding to, is the investment strategy itself. And starting with, what problem are you trying to solve? Does it increase the expected return of the overall portfolio? Does it diversify the overall portfolio? Does it reduce risk or manage risk in some way of the overall portfolio? Or what Christian mentioned in terms of longevity, does it help manage some type of longevity risk? And I think if it doesn't fall into a handful of categories, and I listed some of them, then it's probably not going to be here for the long pull in terms of it's something that you may be able to sell now, but may not be something people want to buy in 2 or 3 years' time. And so I think that when you're looking at new strategies and so on, I think one thing that you're always thinking to yourself is what has legs? What are the conditions that imply something might have some longevity associated with it? And then how can you use that to benefit end investors? So there is a lot more choice, and to put some numbers around it, I think there was around 600 plus active ETFs launched last year, and about 220, 230 active ETFs closed last year. And so when you look at that type of launch rate and closure rate, that's not uncommon. We've seen that in mutual funds forever. If you go back 20 years, less than half of the mutual funds that are around 20 years ago are around today. And so that's something that I think the end investor has to be wary of when they're assessing these various strategies. How long will they last? Because if you're saving for retirement, you're saving for 30 or 40 years, and you're consuming for 30 or 40 years. So you want a set of strategies that will be there for the long pull.
Can I jump in with a quick comment on that? I totally agree with your sort of positioning there about sort of the long-term winners and the short-term, maybe gather some assets on the sly. The challenge has been the market's gotten so efficient, right? I mean, if you're an ETF issuer these days, your costs are so low, even as a new entrant, that we're seeing more and more products linger on the shelves, if you will. This is particularly true in the single stock space, where we've had hundreds and hundreds of products launched, leveraged, options, income. Those products aren't that expensive to run, and they charge so much money that one of the things I worry about is we're going to end up with a world where we have 50 different MicroStrategy ETFs, none of which ever close, because they all have $26 million in it, and that's just enough to keep the lights on. I don't think that really serves investors.
So I agree with Dave, and I'm curious, and hopefully we are achieving your mission, Christian, by having a conversation. So I would ask you two to weigh in on this. For me, I agree, and I think this is an industry challenge and opportunity. If we think that kind of lowering costs and lowering barriers to entry for new products that people want to put out into market and try, is a good thing. However, ETFs require a market ecosystem to function and to function well, and product proliferation certainly creates a tax on the ETF ecosystem. I think the discipline around closures is exponentially more important, and how closures are approached very significantly from issuer to issuer. I think from issuers that, as Dave said, are newer to the market, are putting out kind of a high-priced, strategy. They're not particularly focused on the day-in, day-out market quality, and they're totally comfortable leaving their products out to linger despite minimum asset gathering, versus issuers, like us and many others, for example, who have an extremely disciplined kind of review. We call it our product integrity health checks, where we look at products every year. We create a list to monitor for closure, and we do close products every year. And doing that, from our perspective, actually builds important credibility with the key partners whose support and participation are necessary to deliver an excellent ETF trading experience, the APs, the liquidity providers, the exchanges. And so I think as an industry and I've wondered about this because I don't really think it's a regulatory matter, but I do think it is kind of a industry functioning problem. How do you create this, best practice and expectations around closures?
I might tackle that in a couple of different ways, because there's a couple of aspects to your comments. One, I think, is the closures, and I'll get there in a second. The other, though, is about the investor choice, and how can an investor kind of determine whether they're working with a manager that is launching products with all of the things that you mentioned in mind, and care a lot about the health and the integrity of the strategies that they're launching. I'm a firm believer that financial professionals, whether they're advisors that are independent or they're advisors that work for some larger organization, are a critical component in the overall industry to help the end investor actually make those selections and make those selections well, so that they can choose the strategies that actually have a chance of kind of being around for the long pull and are managed by managers that take all of the small details seriously, because those can impact the long run returns quite dramatically for sure. So I think that's an important piece, and what we might see over time, and this is probably the direction of travel in my view, is that it will become ever more efficient for moms and pops and families to get that type of professional advice, because I think it's going to be ever more important. When it comes to closing strategies, I think there's you have got to start with the criteria to launch the strategy, and Dimensional probably approaches it a little differently than others. It's a kind of where we don't have a lot of experience closing, because we don't close all that frequently, and it's not because the strategies we leave them linger. It's not that at all. It's that because we work primarily with financial advisors and financial professionals, we can sit down and ask, what problems are you trying to solve? And then from there go, okay, here's a solution to that particular problem. We can work with a community of advisors that we have relationships with, and we know pretty quickly whether we can get, and a magic number in the ETF space is like $1 billion. How long do we think we'll get this strategy to $1 billion? And typically for us it's been 6 to 12 months. And so it's not a surprise when we get there, because we've already worked with a lot of financial professionals before we get to the launch. And so I think that's kind of an important component as well. And different managers have different approaches to doing it. That's typically been our approach, where we're not as concerned about where money is flowing in the industry. We look, but it's not a large input into our decisions of what to launch and what to prioritize. It's more the conversations that we're able to have with folks who are kind of able to articulate the investment problems they're trying to solve. But when you do get to a closure, I think then it's a question of the right type of communication and the right type of procedures, so that you're not kind of leaving people in the lurch, I suppose, is the way to take care of it as best you can.
I would point out, these are not representative issuers in terms of launching and closing products. I would say the industry writ large launches way more products than they close currently, and take far less forethought into, is this a long-term billion-dollar product that's solving real advisor problems, or is this something I can sell for 6 months and make a lot of money charging 1.3? That's what most of the industry is launching, is that. What you all are launching are fairly deliberate, aha, we found a niche in the portfolio mix. We think we can add value there. So it's not surprising that you close that much. And Samara, to your point, you guys may have a process for closing, but it's not like you're closing a lot of funds all the time. For the most part, you're only launching funds when you know there's a market. But that's kind of like the 1990s and 2000s way of running this business. The current market is launch it, launch it, launch it, and then ask forgiveness later.
I do think that there are probably still a few like these two up here, but I will comment on I hadn't really thought about the closure side of it as much, being on the offering side of it. We see them before they even come in to launch, and so I sort of use the metaphor of throwing spaghetti against a wall to see what sticks. There will be a ton of launches, but there will be a ton of spaghetti thrown against the wall even before they launch, and half of them or 3/4 of them sometimes don't launch. Slice it, somebody comes up with an idea, and then somebody else tries to slice it and dice it, a dozen different ways, and then somebody else tries to beat them to market with the same thing, in another dozen different ways. I sort of think about, and whether it be various asset classes, various strategies, they are, that's stopped surprising me, that folks will try to launch, in that sort of volume sort of way, with less of a thought, as to, what it looks like down the road. I think we've talked about, complexity from the standpoint of folks who are offering products, but from the perspective of investors or advisors recommending these products, or others in the industry, what should those folks be thinking about as it relates to these novel and complex and investor? An investor, exactly.
I mean, I'll jump on that one first. Just be extraordinarily careful. I mean, that's my advice right now on my blog is trust no one. And it's not because the industry is untrustworthy. It's because you can no longer count on ETF, meaning a certain thing about the asset that you're investing in. Right? The most volatile security in the entire world right now is a trading ETF on NASDAQ. It's triple leveraged QBO. Right, quantum computing. So its current implied volatility is 390%. So there's nothing about ETF that says safe long-term portfolio investment. And what that means as the investor is you have to really do your due diligence. It used to be a shorthand. I mean, 10 years ago, people would just be like, I'll just buy ETFs, everything's fine. I don't think you can say that anymore, not because the structure's broken, not because there's a regulatory problem, not because everything's going to crash, but because the actual as expected delivered returns that you get out of a lot of these products are not particularly helpful.
I absolutely agree with Dave. I would add to that, though, that investors do need a broader opportunity set in their portfolios, given the environment that we're in today. So finding ways to, in the way that is appropriate for their strategies, incorporate options in a portfolio to do a number of things, such as to limit their downside, or to, create incremental income. That's a very useful portfolio tool. Ultimately, and I know your last panel will talk about the importance of private markets and how private markets have become, are a significant part of capital markets today and potentially are diversifying to a portfolio and can offer a different dimension of inflation protection, volatility reduction. Of course, we have to be very clear on our language, and this is something Dave and I have talked about for years, is the importance of kind of taxonomy and standards, because we say private markets, but it actually, that applies to a huge swath of different types of debt, equity, and credit quality of securities. But I think the fact is, threading this needle around creating a broader set of investment opportunities that will capture a broader set of investments necessitates a degree of innovation, and that innovation has been permitted by all of the conditions that we've talked about with respect to both regulation and also technology advances. but also has the effect of creating a lot of like spaghetti against the wall. And so I think that's kind of the crux of the problem that, especially the three of us up here feel, as long-term ETF evangelists, feel very long the rep risk of the category, so to speak, as much as we are, inspired by the opportunity to do more in the ETF wrapper to improve the experience of investors.
And the thing that I would add on to all those great comments is that you don't try to diagnose your own health. If you have an issue, you go to a doctor. You don't try to fix your own car. If you have an issue, you go to a mechanic. You don't try to build your own house. If you're trying to do some renovation or something, you hire a general contractor. I think that too many people try to do it themselves when it comes to investing. And to Dave's earlier point, that's really challenging, ever more so today than it has been in the past. So choice is a really good thing, but too much choice can be paralyzing if you don't have the expertise to figure out how to deal with all of that choice. So I really do think that there will be more and more innovation that comes along with all of the ETF innovation, but in terms of advice delivery. And then how people can use all the great tools that Samar mentioned to kind of build something for them using financial professionals in many different ways that we have today and probably different ways in the future. And technology, I think, will be helpful for delivering that type of a service to families all across the US to give them better experiences with all these different tools and set the right expectations about what each tool can do in different market environments, because there's going to be time periods, no matter what ETF lineup or mutual fund lineup or SMA lineup you have, where results are disappointing. And if you're surprised by those disappointing results, then you're probably going to act rashly and make the wrong decision at the wrong time. And so I think setting the expectations is key. And I don't think that that's a regulatory item. I think that's just, we probably need more and more financial advice in this country. And I think that demand will lead to more supply over time.
This is good conversation. You guys are taking me out of order by answering some of the, or at least my order, as I had been thinking about it. But one thing I did want to sort of touch on, so we've been talking about complexity, but I do also want to sort of focus on some of the shiny things. So when you think about, funds that are out there making headlines, whether it be in a thematic area, what's the latest, AI today, or crypto, or a few years ago, clean energy or clean water or whatever it may be in the thematic space. Is there, can novel products be both attention grabbing and provide long-term value to investors?
Yeah, absolutely, right? I mean, I don't want to sit here and say that nobody's launched any good ideas. There have been enormous numbers of, in the last week, we've had about 150 funds filed, which doesn't mean anything because they may not come to market. Most of them are degenerate. They're like leveraged, this options, they're things people aren't really wanting to buy. But like hidden in there is like, I don't know, Cambria filed for an equal weighted emerging markets ETF. That's actually really interesting. That'll get completely forgotten because nobody's going to notice it underneath the headlines of all this other stuff. So there's actually really great new product coming to market, both from established long-term issuers and from young upstart companies that just have a different way to skin a cat. So yes, there's lots of great stuff out there, but most of it's boring when you compare it to this crypto or that private credit. It just doesn't actually make the headlines because there's so much coming out and there's only so much ink that folks like Bloomberg can dedicate to new ETF launches.
It's funny you call private credit boring or interesting. I mean, I used to think about it in BDCs, and it was like, okay, that's just something that's out there. I know everybody wants it right now. It's just it's exciting now.
I mean, I'd actually love to hear your answer to this question because you guys have been very deliberate in your approach to the ETF market. You haven't been one of these firms that's been spaghetti can and everything. So do you feel like there's a market for you to bring out new, interesting portfolio-based products, or do you feel like you're getting lost in that shuffle too?
Yeah, 100%. I mean, that we think that we can bring out new strategies, new ideas, and I think that we work with a good community of advisors that help support the launches of those strategies. I do think that anything thematic is exactly that. It's here today and gone tomorrow. And thematic, in my view, is very linked to market timing. That you have a lot of investors who like to time markets, and some of them may be successful, some of them may not be. The data doesn't support that you can have much success over the long pull trying to time markets. But for those types of investors that have that view, I think most thematic strategies are kind of more of a market timing. You think that a particular segment of the market is good to be in now, so let me get a vehicle that allows me to express that view. And you can do it more efficiently today than you could ever do it in the past. That's not typically been how we approach it at Dimensional, because we think about things for the long pull. So a lot of our strategies are kind of, I would say, more around how do you take, like there's an analogy that I like. It comes from Professor Murphy at the University of Chicago, and a lot of people talk about outside the box thinking, and the analogy is about the fallacy of outside the box thinking. It's actually not that useful. Most things are outside the box because they don't work. And that's why they're outside the box. And it's much better to have inside the box thinking, which what you do is you use things that are already in the box to expand the box. And I think it's a better way to approach incremental improvements and incremental change, because you're using tried and tested things that have been used in a particular way, but a slightly different way to make the box bigger. So I think that's generally how we've approached it over time. And you see the business grow and grow, but it's not because there's some amazing new idea all of a sudden. Is that you've incrementally added to the overall repertoire, which then doesn't grab the headlines in the same way as some other strategies. But I think it's the steady approach generally for us works better. Yeah.
I would just add to that, I think we need to remember that what feels outside the box today, like the box changes over time. When I came into the ETF industry 10 years ago, it was having spent my entire career prior in the bond market. And even 10 years ago, people thought largely putting bonds into the ETP wrapper was a pretty high-risk proposition. And as it turns out, not only have bond ETFs delivered in tremendous ways for investors across the kind of spectrum of duration and credit, they've actually also contributed to resilience and price transparency in the underlying bond market. And so thinking about how, again, you thread the needle to apply that thinking to parts of the market that feel novel today, but might actually be suited, and not everything is, to the ETP wrapper, can actually change our concept of what a novel market is. And I think instructive for a moment to just talk about the iShares Bitcoin ETP, which I will be clear, as Commissioner Peirce said in her opening, not an ETF, but kind of instructive in terms of thinking about new and novel. And in the ETP wrapper, the way we think about a new launch at iShares is it has to satisfy four things. And it was a real journey for us before we decided that Bitcoin did. Number one, that our clients wanted it, and they wanted it in the ETP wrapper. And that's something, starting probably 3 or 4 years ago, we started to hear in a much different way than we had prior to that from investors. That number one, they were interested in holding Bitcoin, and number two, the existing avenues for them to do so, self-custody, proxy vehicles, were, not nearly as attractive to them as an ETP. Number two, we had to, believe that we could build the operating model to operate a Bitcoin ETP at scale, that we had the capabilities on our platform. Number three, that that the ecosystem was ready to support ETP operations at scale, that there were sufficient liquidity providers, price transparency, authorized participant support, and of course that the regulatory environment was conducive to launching a Bitcoin ETP. So investment thesis, client demand, platform capabilities, and ecosystem support. When something checks all of those boxes, for us there's a very compelling reason to launch, and we did then. And one of the really important learnings from the IBIT launch is that probably half of the, and still today, half of the holders of IBIT are what we call self-directed investors, so not advised investors. Many investors, and half of the investors in IBIT who have made allocations to Bitcoin, and this is a very fast-growing investor segment. And I know, like, people call it retail, but I find retail kind of a very broad category. So this kind of self-directed investor coming into Bitcoin, on their own, without advice is an important generation of investors. And by the way, I'm the mother of teen kids, so I often think about how do we bring them into the market. And when they first come to the market, they're not really differentiating between an ETF or a public equity or a token. And so how do we get them to engage and ask for advice, and they are looking for advice, but they're looking for it in a very different way than kind of the traditional advisor model. So a lot of this new and novel also comes down to, starting a dialogue and a connection with this new generation of investors.
Can I just jump in one thing? One way I think that's helpful, we talked about this last night, we used to think about taking people from being like wage slaves to savers to retirement investors to maybe self-directed investors, right? And that was the journey we wanted people to go on. That's George Bush's ownership society, right? Buy a house along the way, build your portfolio. The reality of the current market is the new investors are coming in on sports betting and crypto. That's what they've been doing with their money. And now we need to talk to them about, hey, you know what? There's smarter ways to think about your long-term financial health than just those two things. But that's the entry window, right? I mean, there's a reason why folks like Robinhood are launching both sports betting and crypto. It's because that's actually their funnel to bring people into asset management, oddly enough.
So, Gerard, your conversation about being inside or outside of the box is going to take me in the next direction to a question that I had for you, which is that while innovation can come in the form of big, bold moves and new ideas, it can also come in the form of iterative improvements, adopting and improving upon ideas pioneered by others. For example, the ETF share class was pioneered and for a time patented by Vanguard. Dimensional is one of the many firms that has filed for exemptive relief to offer ETF share class of its traditional mutual funds. And you were recently quoted as saying that this product, dual share classes of mutual funds and ETFs, could potentially revolutionize the ETF and mutual fund landscape. Could you elaborate on your perspective, explain what this development will mean for investors and the industry, and describe Dimensional's journey up to this point?
Yeah, happy to. And before I begin, I want to say thank you to the Invest Management Division for all the conversations that we've had over the past couple of years. They've been very productive, and I think that we've been able to collaborate and work pretty well to get where we are today. I'll start a little bit with Dimensional's journey and then talk a bit more broadly. When Dimensional first got into the kind of after Rule 6c11 decided to launch our own ETFs, it was clear from the advisors that we work with that they were interested in having ETF share classes of the mutual funds. And the main reason for that was around the ability to be able to convert some of their mutual fund shares into ETF shares for the families they serve, because the families would have a retirement account, they would have a brokerage account, and on the brokerage account they wanted to have ETF shares. They didn't want to pay taxes to sell the mutual fund shares, go to ETF shares. And so we kind of had a three-pronged plan at that point, which was launch standalone ETFs, convert some of our mutual funds to ETFs, and then work on the ETF share class. We had conversations with the SEC back then, 2019, 2020, and in 23 we applied for the exemptive relief and kind of focused on the benefits to the investor, and then tried to address as well as we could the concerns that we understood from the release notes of Rule 6c11 around brokerage costs, around cash, around tax efficiencies, and so on. And so I think that's been a good part of the journey up till now, where I think that the latest, we filed another amendment last Thursday night, so it went public on Friday. I think there's already been one or two additional filers that have kind of taken that new amended filing and amended their own filing. So kind of we're still in that journey. that where I think that we can get to a great spot that, at least for some strategies, I don't know that it'll be for all, where the benefits and the most straightforward benefits are economies of scale of having a different access point to the same pool of assets or multiple access points to the same pool of assets, and being able to address the concerns that we've understood from the staff, as well as leverage the benefits that we think will accrue to investors. I think that we're kind of far along on that journey. And so we'll see where it goes to from here. The kind of more broad comments are, when you look at the two industries, if you want to call them that, you have 10 trillion plus in ETF assets, you have 25 trillion in mutual fund assets. Those two don't have to play together. And there are distinct benefits for having, again, not for all strategies, but for many, to have some client activity happen in cash and some client activity happen in create and redeem, and especially for active strategies. Not as much for index, but especially for active strategies. And we've seen a lot of growth in active type strategies come in ETFs, and of course there's a lot of active strategies in mutual funds. I won't go into the details of what those benefits are, but it kind of goes to Samara's earlier point around taking care of all the nuance, whether it's the interactions with the APs, the market liquidity, the market makers, how you're doing your create and redeem baskets, all of that infrastructure. I think all of that plays an important role. But ultimately, what you could see is there are still a lot of investors who like to trade for NAV. There are still a lot of investors who like mutual funds. There are still a lot of platforms that only can handle mutual funds. There are still a lot of investors who love ETFs. There are still a lot of investors who like to trade at market prices. There's no reason that they have to experience different sets of returns. They can enjoy the same return stream, access to the same underlying pool of assets, have ETFs in their tax-deferred account, or in their taxable account, have mutual funds in their tax-deferred accounts, and be quite happy with that. I do think that there are some risks that come along with it, and I think, Samara, you're kind of highlighting this earlier on, which is, can the infrastructure on the ETF space handle if there's 1,000 ETF share classes that come to market in a year? That's going to be a lot of strain on the infrastructure. I think that strain has already been experienced, to be perfectly honest, and this goes to ETFs that may be sitting on the shelves and not having as much of an active secondary market, where you may see things like ETFs distributing capital gains more frequently because they don't have access to the right amount of balance sheet to do rebalance trades and to be very, very efficient in their implementation. So there's no doubt that it comes with some challenges. But I think if you go out 5 to 10 years, it doesn't strike me as why those two pool of assets should be separate at all. I think that the market will develop, the infrastructure will develop, and it'll just become more and more common that if you're launching something, well, let's have 2 access points to everything that gets launched rather than 1, because it doesn't increase the cost materially, and it may give you different avenues to help grow a significant investor base, which then improves the longevity of the product.
So Dave, you recently gave an interview where you commented on quant-driven investors getting into the ETF space. Can you tell us what's going on in the ETF space these days as it relates to quant strategies?
Yeah, I don't want that to be misinterpreted. I'm not talking so much about like smart beta quant, right? That we had our wave of that. If you actually like hang out with a lot of people who are very markets focused, the nerdiest ones are the ones who talk about options Greeks all day, right? That's where the quants really end up living, whether they wanted to start there or not. Those folks are all in the ETF industry now. And so if you look at the options market writ large and the major players there, all anybody is talking about is either being in the ETF market, i.e. launching these products and being on the desk that's trading that, or being on the other side of these products, making bank trading against those strategies. The fundamental problem we have with a lot of these quant-based strategies is they're all going the same direction. Right? Even the leverage and inverse products all have to rebalance the same direction every day, whether they're up or down, just because of how that math works. So what we end up with is a whole lot of very quantitative driven, effectively pseudo market makers on the other side of these giant ETF options trades, which are largely rote and predictable, right? I mean, if your strategy is every month you reset on the first of the day with a 30-day option, guess what? Everybody on the street's going to be trying to figure out how they can take advantage of that knowledge. That's really the problem, is that it's a little bit of asymmetric warfare. The simple versions of these quant strategies end up in a ticker, right? Whether that's a buffered product or just an options income product. It could be very, very boring by today's standards, but it's very simple. The other side of the street is doing complex work to trade against that. And that's where I tend to get, my some concern tends to be on that disconnect, because both participants are relying on the same underlying infrastructure to make those things happen. They all still have to clear at the Options Clearing Corporation at the end of the day. They're all still working with the same 6 to 10 firms in Chicago who are taking on or moving that risk around. That's where I start to worry about, you were talking about capacity constraints. I'm guessing you were meaning more in terms of things like getting access to a market maker who's got some balance sheet to do a rebalance trade, but sort of what you're talking about. I think there are other pockets of the ecosystem that we don't pay that much attention to that are dominated by math. They really are dominated by math.
It's fascinating. Shifting gears away from the complex strategies, we've seen ETFs that have been pretty simple, that have pretty simple strategies, but even some of those can raise questions. For example, Samara, BlackRock launched a money market fund ETF not long ago. Money market funds are pretty easy to understand, and they serve an important function. I'm curious to understand the purpose of a money market fund within an ETF wrapper.
Christian, when we had our prep call and you told me you were going to ask me about money market ETFs, I remember thinking, really? Like, with all of the exciting stuff that's out there, like we've got private markets and derivatives and quant strategies, and you want to go to cash first, and I'm so glad you did, particularly after the again, my favorite Forever Young panel, and actually thinking about the history at the SEC of delivering cash in fund format to investors, because that was literally a part of almost everybody's commentary. And we've kind of built on that up until today. So just as money market funds in their infancy were important because they gave people interest on their cash that they weren't getting in their bank deposits, and ensuring they could do it in a way that was resilient and didn't break the buck and had close to the same expectations as they had in their bank deposits, is an arc that just continues today with the desire for exchange tradability and access in an ETP wrapper. And the unlock that was new, particularly in the past year, is having something that both builds on the work and the standards that the SEC has set for money market funds with 2A7 with ETFs, and bringing both of those things together was kind of the new innovation this year. But again, building on a history of how you deliver cash in a way that allows the providers of that cash to be paid for the utility of providing that cash. And I think that's an important way to think about it, especially in light of the tokenization panel, because part of the modernization of capital markets is ensuring that people are adequately compensated for their contribution to capital markets. And when you put cash out and you aren't using it, you are providing utility to somebody else, whether they are using it as collateral or making loans, and you should be paid for that. And so coming up with structures that allow for interest to be paid in a competitive way to providers of cash is an ongoing theme that is driving developments in stablecoin, in crypto, and in the ETP market through money market ETFs.
Can you give us a sense, the why in the ETF wrapper? When I guess when the staff was reviewing these products when they first came in, we were sort of thinking, okay, well, if they operate as they're supposed to, $1 in, $1 out, what is the change that in experience that an investor will have if it's in an ETF wrapper as opposed to just the traditional mutual fund wrapper?
Well, for all of the things we've talked about already, ETFs are where investors are holding an increasing amount of their portfolios. So number one, there is just the whole portfolio desire to have building blocks, including your cash building block, be in ETF format. That's number one. Number two are kind of the increasing use cases of ETPs, and again, we see this in tokens as well, as collateral in derivatives transactions, which is something you can't do as easily with a mutual fund. And so again, it's combining the ETP wrapper with 2A7 treatment, which is familiar and a clear standard that was so significant to the market.
So I know we've spent like almost all of this time talking about ETFs, which is obviously where a lot of product innovation is happening these days. But as we know, there are some other fund types, that fall under the purview of the 40 Act, mutual funds, various types of closed-end funds, as well as some others. From a product innovation perspective, are there any observations you would like to share with respect to other fund types, non-ETF products?
I can jump on that one. I'm very excited what we're seeing in the interval fund space right now. We had 2 product launches in the last month, both Capital Group KKR based, they're private credit products. That's where those kinds of, in my opinion, that's where those kinds of investments belong, right? In a less liquid vehicle than the millisecond liquidity you get out of an ETF, right? There has to be some sort of gap between millisecond, daily, and once in a while, and that's where interval funds fit. And I think as we see more and more interest in private markets, whether it's private equity, private credit, private real estate, I think we're going to see more and more interval funds as the way of delivering that, just because the ability to gate exit liquidity is really important to running those strategies well, right? I mean, we want investors to have the good experience of the asset class they're trying to buy. It's very difficult to do that when there's a massive liquidity mismatch between the underlying and the expectation of liquidity in the trading vehicle. So I would expect to see more coming out in the interval fund structure. I would expect to see issuers putting a lot more energy behind educating financial advisors about that structure, because there are only about 150, 200 of them in existence right now. But I do think we're going to see more and more innovation there. I don't see a lot of other pockets of innovation under the 40 Act. I don't see folks doing anything particularly interesting in closed-end funds right now. I don't see a lot of big interest in coming up with new ways to do mutual funds better. So to me, ETFs and interval funds are kind of where the action is. But are you guys developing in any other structures I may not have thought about?
I think the only addition I would make to that, and this is a longer term trajectory, and obviously there is a lot in flight right now from both a legislative and regulatory perspective, but is the opportunity for tokenization to evolve and improve upon existing fund structures. And I think it's super interesting, and there's a lot of parallels between the ETP adoption trajectory and I think what I expect will be the tokenization trajectory. Number one, though, is this mythology that you magically create liquidity in a secondary market by tokenizing something or putting it in an ETP wrapper. We know that not to be the case. However, with the right set of conditions and ecosystem readiness, the wrapper can be additive to the market. And I think this important question that we see in private markets, and may actually, to your point, Dave, when I said ecosystem readiness, I do include like options market structure as part of that ecosystem readiness. And I think part of the solve for this kind of challenge around adopting much more complex products to the scale of operations that are ETFs is the application of frontier technologies like blockchain and tokenization. So that would be my addition to what you said.
One addition there, and both great points, and this is not to do with the commingled strategy at all. I think it's going to be interesting to see how SMAs, separately managed accounts, grow over time, and how many of the assets of families saving they actually garner. I don't know how it will work out. You'll have different projections from different folks about size of mutual fund versus ETF versus SMA market. But the attraction there of either customization on the asset allocation, customization on the taxes, and the technology and presumably things in the blockchain and so on will improve that technology. But the ability to deliver a totally customized experience at a very low AUM while still having a profitable business, I think has increased over time. So that will be something to keep an eye on, because if more and more assets move out of a 40 Act regulated space, I'm not sure what the implications of all that will be, but certainly something to keep an eye on, because there are lots of strong asset flows into different SMA programs.
So moving on to a topic that has been a discussion point for a few years now, retail access to private markets. I know the next panel will cover the retail, we'll cover this in more detail, so I don't want to front run their discussion. But I do want to acknowledge the intersection between product innovation and the pursuit of strategies to offer retail investors access to alternative investments. While it's not a new asset class, we've seen products launched with an aim to deliver this type of exposure in new ways. Is there anything in particular from a product innovation perspective that either excite or concern you? Are there any key considerations that are important to keep in mind when offering private asset exposure in the 40 Act products? And lastly, as a nod to the earlier panel, is there a role, and you jumped on this a little bit just a minute ago, of tokenization, that might play as we think about product innovation in the context of investing in private assets?
So I'll just kick off and really build on Dave's excellent comments around solving for the liquidity dimension and the potential of interval funds, which I think are spot on. I think one of the key foundational requirements for a market to provide investor access at scale is data and transparency, which largely needs to be further developed in private markets, where you have, by definition, bilateral bespoke deal structures. And for, one of the themes that we talk about a lot at BlackRock is this concept of parameterized investing, which is the ability, as opposed to trading at the very granular deal-specific or CUSIP level, allows investors to meet each other based on the parameters or characteristics of an investment. And bringing this sense of parameterized investing more broadly to private markets will require a much more foundational data level that allows for the creation of benchmarks. And I say, just so that there are performance standards, and this is without arguing around whether we can yet index private markets. Indexation is an organizing construct for any market because it creates a performance standard to agree with an investor what it is you're trying to deliver. And so I think kind of the key, need right now, and potentially new technologies will help in dissemination of this broad set of information and agreeing on characteristics. But I think that's one of the prerequisites to access at scale to private markets.
Yeah, I would just add that transparency in private markets is not uniform, meaning if we're talking about private credit, oversimplifying with a very large brush, pretty much all credit trades on yield and probability of default. We get into a lot of math around the corners, but ultimately, what is the yield? How likely am I to get what I'm supposed to get at the end? Is it amortized? Is it not amortized? So while there is a transparency need in private credit, a lot of the transparency sort of shows up in pricing already, and so I'm less worried about that. Private equity is a whole different kettle of fish. We had the panel earlier where we were talking about the sort of demise of public companies in this country. And, I think it's, what's the stat, like 80% of companies over $100 million are private in the US. That is a problem, and in my opinion, that's actually the problem we should solve, not the trying to get everybody access to all of these less regulated private companies. So the transparency inside a Klarna or a SpaceX or OpenAI, that transparency is very difficult to bring up to the level where I think we'd all be comfortable building an index off of it, because we don't have the same considerations we would have if it was a, NYSE trading piece of equity like everything else. So that to me is a little intractable. I don't know how you get retail access to private equity without solving that transparency problem. And to me, what we should probably be doing as a society is figuring out why companies don't go public anymore and solving that problem, not well, let's just get everybody into the private markets, because that's another way of saying we're just not going to regulate it. And I don't think anybody really wants that.
Yeah, what I'd add there, and I think Samara has it spot on, which I'll go potential benefits, potential drawbacks, is that some of the potential benefits of innovation that's happening in terms of trying to put private market securities into 40 Act type vehicles is the transparency and is more regulation and so on. Because as it stands today, there is a large academic literature around the performance of private market managers. And it is inconclusive about whether there's any alpha. That's what it is. You have 20, 30 years, and it is inconclusive. And it's inconclusive about whether there's any persistence among the performance of private market managers. Why is that? Because the data are so poor. Plain and simple. The data are full of biases. You report when your returns are good. You don't report when your returns are poor. Because it's internal rates of returns, you can fudge those all day long. If you have a particularly good investment, sell it early and your internal rate of return will be 80%. You average that across all of your series and you look like a hero. There's all sorts of games that can be played which make it very hard to assess. I think that if you have more data on it and more requirements around reporting, I think that makes it more straightforward to assess what the benefits of investing in private markets are. And I think Samara's point on indexing that can help you with that is a very, very good point. I think the drawbacks are exactly some of the ones that Dave mentioned, which just coming from space where, you do due diligence on different managers at different points in time, the amount of due diligence that you need to do on a public market manager is high. The amount of due diligence that you need to do on a private market manager is astronomical. And so to think that the average mom and pop will be able to do that due diligence, I don't think that's plausible yet. And so in as much as those, if they are included in 40 Act type vehicles, in as much as it kind of makes it more standardized, lessens the need for that in-depth due diligence, that may end up indeed being a benefit. But it's going to be interesting to see how it plays out. If you do have a lot of firms trying to include a lot of private market securities into 40 Act funds that require daily liquidity, I can see lots of ways in which that could go well and lots of ways in which it could go poorly. So we'll see.
Just to add one comment to what Dave said, I'm not sure these problems are, I think these are related problems, right? I think that presumably there could be more of a continuum of a company's journey from private to public, and more transparency and data availability could potentially kind of aid on that journey. So.
Yeah, absolutely. And other countries, other jurisdictions have more of a
Yeah.
graded approach. I mean, in Canada, there's steps. You can go to the venture exchange, right? You have a different set of reporting requirements, different set of liquidity requirements. I could see, I mean, in the US, really, we sort of have the voluntary SEC reporting company thing, which is sort of a way of sort of almost thinking like you're public, but there's no teeth to that. So I don't think anybody takes that seriously either. But I agree completely. Having some sort of gradation would make an enormous difference.
So I'm going to do two things very quickly. We're starting to run short on time, or we are very short on time. But one thing that I failed to do at the beginning of this, which my boss Natasha and Commissioner Peirce did, was give my disclaimer, which is the statements that I make are my own in my official capacity as an SEC employee, and do not necessarily represent the opinions of the staff, the commissioners, or the commission. But because we are running short now on time, I have one open-end question which could actually blow this all up. So I'm gonna say it as a lightning round. So the question is, to close this out, what are we not talking about enough?
We have talked about this a little bit, but I think as an industry, we need to be talking more around how we apply frontier technologies, especially AI, to improve the investor experience. I think this is an industry challenge, not a regulatory one. There is an enormous amount of disclosure that is available to individual investors. They can't consume all of it, but I do think we have the technology tools available to make that body of information much more consumable. So I don't think we're talking enough at an industry level around how you create kind of a industry-approved, data set that an investor could apply a ChatGPT deep research lens to come up with the customized disclosures for them based on what their goals are, their risk tolerance, all of those characteristics that are unique to them. We have that technology today, and we have huge amounts of information that are being put out to investors by issuers. And the problem is an aggregation one, and it's solvable. So I would like us to be talking more about that.
Yep, I agree with that. I have a different one, but I agree with that one too. And I think ChatGPT has made amazing. I mean, you can now use ChatGPT to search Edgar, which is phenomenal. But to me, it's the ecosystem stuff that we've talked about a few times on this panel, but this is probably the only place I've gotten anybody to talk about it in the last year. Whether it's the market makers who need to actually stand behind the other side of these products trades, whether it's the options clearing corporation being there for a settlement failure, those points of failure are the ones I worry most about, especially as we get 1,000 to 3,000 new products launched as share classes. Somebody has to be hedging the other side of every one of those trades for those products to actually function the way they're designed to. And we've got examples where it's not working. We had a cat bond fund launch without a market maker that trades at barn door spreads. Doesn't help anybody. So that's what I worry about.
I'll go back to something that was mentioned earlier, and I think Samara has a good point on this one. It's just we're not talking enough about how families are going to have the tools to actually consume all of these products. And so whether it's some type of AI set of tools that will help to make more informed decisions, or how do we deliver advice more efficiently? I think that's a very, very important problem, not just in this country, but all over the world. How do families get the expertise that they require at a reasonable price to become long-term investors and more successful investors?
Thank you to all the panelists. I think that this was successful in that you guys were all, bouncing back and forth between each other. There were points where I did have to try to force my way in. So thank you, guys. I do think it was successful to Samira's question. Thank you.
That should serve as a nice segue into our fourth and final panel, Retail Access to Private Markets, for which we will reconvene here in a few minutes, kicking off at 3 o'clock. Thanks. Okay. Hi, everybody. We're going to kick off as folks trickle in here, but I want to introduce panel number 4, our final panel, Retail Access to Private Markets, moderated by Jana Morris, Chief Content Officer at Ion Analytics. And Jana, I will throw the ball over to you for introductions. Thanks.
Perfect. Thank you, John, so much. Thank you and welcome, everyone. This is Retail Access to Private Markets panel. today with us. We have an incredible lineup of speakers with very diverse opinions and diverse backgrounds. And I'm going to ask you guys to introduce yourself, starting with William.
Hi, I'm Will Clayton, and I'm delighted to participate on the panel today. I am a professor at BYU Law School, and I write primarily about investment funds with emphasis on private equity. And I, before coming into academia, practiced, did a mix of M&A and some private funds work.
Hi, everyone. My name is James Hannigan. I am the head of product structuring at Apollo Global Management. We are an alternative asset manager with $785 billion of assets across a range of strategies, the largest of which is private credit, with about 600 of the 785. By background, I'm a 40 Act lawyer and have spent my career in a space like this, which is helping to adapt strategies to fit within regulated products.
Hi, good afternoon. Mark Rubelard. I'm a research analyst on alternative investments at Fidelity Investments.
Good afternoon. Ben Schifrin. I'm the Director of Securities Policy at Better Markets, which is an organization that advocates for financial reforms that benefit investors. Before going to Better Markets, I actually spent 18 years at the Securities and Exchange Commission, so I'm delighted to be back and to see some familiar faces. Hey there, Brent.
All right, wonderful set of panelists. So we're going to get right into it. Mark, I just realized that we out-lawyered. I think between me and you, we're the only non-lawyers on this panel, so you're all in for a treat. So before we begin, I wanted to remind everyone that we're actually sitting in the house of Securities and Exchange Commission, which is exciting in itself. And of course, the primary role of Securities and Exchange Commission is to first facilitate efficient markets. It is to allow for formation of capital, but then also to protect investors. So as we're debating this topic today, we have to kind of remind ourselves of the dichotomy that exists in formation of capital on one hand with private markets and protection of investors. And I think within this topic, there's quite a few challenges, but there's also quite a few opportunities. So today I'm hoping that we're going to bring some light into both sides of the question, the challenges and the opportunities. To set the stage, what I wanted to do is to define the two sections of the markets that we're dealing with. On one hand, we have private markets. On the other hand, we have retail investors. So I will start with private markets and try to define what it is. And then, Mark, I think I'm going to go to you and ask you to define what is retail, who is retail investor, how big is that market, and why are we talking about retail investors? Why is it becoming so important? So to begin with, private market is defined as transactions between non-listed companies, right? And if you had to size that market today, depending on what you put in that definition, it's somewhere between $15 and $30 trillion. Again, definition of taxonomy is very important. But I will stick with the buckets that are very well known to everyone, right? And within that 15 plus trillion dollars in asset under management, we have private equity, which is the largest bucket where James and Apollo belongs. Then we have real assets, which is, of course, real estate, infrastructure, natural resources. We have venture capital, very important part of the market. And last but not least, we have private credit, which is in headlines almost every single day. It tripled in size, no, actually grew 5 times in size since JFC, and becoming a very important source of credit to private market. Now, as we all know, private market investors are typically institutional investors, and by institutional investors we mean pension funds, mutual funds, insurance companies. So, Mark, why don't you help us to understand what retail market is?
Absolutely. That's a great intro on the private markets. In preparation for this panel, I tried to do some research to size these markets and the clients within. And I just have to say, because I thought it was a fun word, The global capital markets represent $1 quadrillion. I haven't been able to say quadrillion before, so that was fun. So when you think about that, as Yana talked about, the global asset management industry collectively manages about $110 trillion. So that gives perspective to the alternatives industry, which is, as Yana mentioned, somewhere between 20 and $30 trillion. It's very hard to capture these exactly because these are private markets. But when you look at most reports, they center on around those numbers. And when you look at the US represents about half of that amount, whether that's 20 or 30 trillion, let's just say it's 20 for easy math, but half of that is represented by US investors. And of that, about 80% is represented by institutional investors. So that's the dimension of like the overall capital markets. So when you think about what is the investor base, in the US investor assets are around $90 trillion. And of that, about 65 trillion is professionally managed. The split is roughly 1/3 institutional, 2/3 retail. But there's an important distinction within that, is that 401k plans, you could put really in either bucket. Because if you're a 401k plan, the individual investor may or may not have much discretion in the underlying investments or what they can choose from. So depending on the report or whoever's doing the stats, they may put 401k plans in the institutional bucket. So I just put that out there because just to show, as I mentioned, there's a lot of nuance here. And it's not easy to understand. Terminology is very important. And so just when one person says one thing, don't necessarily assume that what they're saying is the same way you understand it. Understanding terminology is very important. So when you put all those numbers together, and the last part of the puzzle to define what is this opportunity is what is the potential allocation? When you look at institutions, who I think most would say are fairly seasoned in their allocation, seasoned being that they're probably not going to double it from here, their average allocation is about 23%. It varies amongst the different types of institutions, but somewhere between 20 and 30%, let's say, is a fair estimate of where institutions allocate to the alternatives market. Retail allocation is much, much lower. Single digits for sure, probably closer to the 2 to 3%. And so if you did simple math to say, all right, we're going to go from some small amount and go 20% of the retail amount, that's around $8 trillion in assets to the alternatives market for the retail client. Obviously, a significant area of opportunity or growth when you have a US-based market of alternatives that's currently around 10 to 12 trillion. So almost a doubling of that. Now to get there are tremendous hurdles, and I think this panel is going to do a great job of highlighting what those hurdles are and the intricacies involved. But to take a step back, as any allocator should, when you look at an asset, you have to ask yourself, well, why would I do this at all? Why would I go through the effort? Why would I care? For private markets, and these, I should make it clear, these are my statements. I'm not speaking on behalf of Fidelity or anyone else. These are my statements. I believe that we look at private markets really on two perspectives. The first one was mentioned earlier today by former Director Norman Champ, is that economic growth is increasingly happening in the private markets in the United States. The amount of public companies has declined by a significant amount, about 40% over the last 25 years. And so while the economy has significantly grown. And so it's about providing access to different types of investments that are increasingly not represented in the public markets is one aspect. So broadly diversification. And the other is the potential for enhanced returns. The literature is complex here, and it takes some time to understand it. But in diving into it, there's very multiple ways to look at this and say there is a potential for enhanced returns in private markets over public markets. But again, it is a nuanced conversation. And that's where I think we're going to get into is, okay, if we believe that there's merit to delivering access to private markets to retail, how do you do it? That's where the fun starts.
Very true. James, I'm going to slowly but surely keep picking at Apollo throughout this panel because Apollo is known for being a firm that constantly pushes innovation boundaries in private markets and very much known for that. So Apollo, $800 billion company, has access to public markets listed company, didn't really have any problems fundraising, unlike many competitors did in the recent past. So why would Apollo need retail money? Like, what is the benefit of someone as sophisticated and entrepreneurial as Apollo to have access to that market?
Sure, and I should probably, as Mark did, acknowledge. I'll offer my perspective. Can't probably speak for the whole firm, but I do. I think we start from the perspective of the client demand, and as we see. The tools that institutions have used in their portfolios for 30, 40 years, you had the individual investor marketplace that was coming to us and saying, how can we too, participate in the deal flow and in the solutions and strategies that Apollo and others are expert in. I think as we, you think about the broader trends of, as Mark was describing it, the mix of individual investors versus retail investors, versus institutional, it is an expansion of the opportunity set, and it allows us to continue growing, but all the while, needing to make sure that, we're staying true to the premise and the ultimate goal of excess return and diversification. So it has hopefully been a thoughtful decision to expand our product set and only in areas and with solutions that can be portfolio enhancing for those individual investors.
So what I'm hearing from you, Mark and James, is diversification. It's important in this case. Innovation, to actually bring innovation that Apollo already experienced with other markets into retail. Very important. We haven't mentioned this yet, but public market is shrinking. Yep. We all know that, right? Even though it's between 100 and 120 trillion today, it has been shrinking every year for the last decade. So we need another avenue, right, to, as Mark said, to deliver those superior returns. But I am going to ask William and Ben to build a counter argument. Why not allow for retail money to flow into alternative asset managers? Whoever wants to start first, I can see you both jumping on this question.
Well, I think the concerns are that private market assets tend to be more opaque, more liquid, and more expensive than public market assets. And so that's concerning when you're talking about marketing those assets to retail investors. And I think the previous panel talked about this at the end. There's just a lack of transparency when it comes to private market assets. And the reason for that, right, is, I think we have to start from the beginning. The default under our foundational securities laws is supposed to be a registered public offering. You need an exemption to do a private offering. And over time, those exemptions have gotten bigger and bigger, which I think is one of the reasons for the shrinking public markets and the rising private markets. But, they're supposed to be private placements that are the traditional exemptions. And if we're going to allow retail investors this huge market to get into the private market space, it's hard to think about how that's going to be a private offering. That sounds a lot like a public offering where you're supposed to have disclosure, and that disclosure just doesn't exist when it comes to private market assets. You're not required to tell investors all about the company, about the business and financial aspects of the company, and you're certainly not required to do it on an ongoing basis. And I think that could present huge problems for retail investors. The whole reason that the public markets have worked so well for retail investors, I think, is because there's disclosure that protects these retail investors. So I mentioned the opacity or the lack of transparency. I also think the liquidity is a huge problem. I think retail investors are used to being able to get in and out of their assets quickly, and that's just not the case in private market assets. They just don't trade all the time. In the public markets, you can kind of see what the prices are for those assets on the exchanges, and you can't do that in the private markets. And so both the lack of transparency and the liquidity makes it hard to value the assets. And so if you're a retail investor, you don't really know what the assets are worth the way that you do in the public markets. And then I also mentioned that they're more expensive. I think the fees are just much higher in the private markets than they are in the public markets. And so you have this potential for investors paying more for much riskier assets. And then the argument is, well, why would anybody do that, right? Why would anybody pay more for riskier assets? And then the argument is, well, it's their potential for greater returns. And I think the word potential there just does a lot of work. As was mentioned at the end of the prior panel, I think that the evidence is inconclusive at best as to whether you can really get greater returns in the private markets, especially after accounting for the higher fees.
And just picking up on that, for many years, the takeaway of nearly every academic paper that was written about mutual funds was pretty simple, and that was we need to get retail investors to stop paying for high-priced, actively managed products and invest in passive index funds instead. So sort of taking the disclosure point, if no matter how unsophisticated you are, you can invest for the long term and know you're getting the market return without doing any research or having any inside connections. And the public markets are built so that unsophisticated investors can indirectly benefit from the profit maximizing actions of sophisticated investors in the market. Private markets really aren't built that way. So it took a long time to get to a point where investors sort of heard that message. It's a very simple heuristic, sort of like don't do drugs, right? Don't invest in actively managed products was, I think, the message that academics were trying to get into the market, and eventually the market heard it. And so as we move down the path of thinking about expanding access to retail access to private markets, it makes me a little concerned that there already are and are going to be more resources focused on trying to persuade and market to retail investors to do the opposite of this sort of simple heuristic that we've been trying to inculcate in the public for a long time. And it feels a bit like we've spent years trying to secure kind of hard-fought ground, and now we're kind of ceding that territory potentially as we're looking at this space. It also concerns me that this is happening at a moment in time in the private funds industry where it's maturing, potentially facing the prospect of lower future returns. It's also currently in the middle of a liquidity crunch. So it makes me somewhat uncomfortable to see an aggressive campaign for retail dollars when the industry is struggling to return capital to LPs. Many of their LPs having sort of hit their max allocation and are cutting back on their allocation to private equity. And then one last sort of high-level observation. I think it's tempting to conclude that because private funds have grown so much, that this evolution towards bigger private markets and smaller public markets must be a movement in the direction of efficiency. It's a really hard thing to measure, but I'll just note that if you think about this from the perspective of incentives, the growth of private markets has been a boon, I think, for most of the investment professionals, most of the lawyers, most of the consultants who are making decisions about where to allocate capital in this investment management ecosystem. Obviously, it's good for private equity sponsors as they increase their AUM. Maybe more counterintuitively, I suspect it's also been good for the staff making investment decisions within institutional LPs, like endowments and public pension plans. Why is that? Investing in private markets kind of magnifies the importance of the role of the person sitting within that institutional investor. So there's more for them to do, precisely because there's no clear standardized disclosure, there's no clear market price signal, and there's not a level playing field, so more expertise and experience is needed than if the institution was just investing in registered products. And I think the same goes for investment consultants and lawyers and bankers, anyone offering services in the investment management ecosystem. When you don't have publicly available templates and precedents and market prices, those inefficiencies and frictions allow you to charge more for your services. So I think, clearly it's good for just about everybody in the ecosystem. Open question whether it's good for the retail investors themselves. So those are a few reasons I'm sort of hesitant as we think about this move to expanding access to retail investors.
William, I think you, in a very elegant, very academic manner, just asked James, why should retail money resolve private equity cash problem?
I think I would just start by acknowledging that the umbrella of private markets captures a lot of different asset classes. Everything from investment grade credit to through real assets to equity strategies, levered and venture that are more speculative. From our perspective and from my perspective, certainly acknowledge the trade-offs that both Ben and Will, have articulated in terms of transparency, reduced liquidity, higher fees. I think the degree of those trade-offs can vary by asset class. So on the last panel, there was an acknowledgement that in the credit space, valuation is less of a black box. Beyond valuation, when you think about investment grade, there is greater transparency. There is the benefit of the independent rating. There's increasingly secondary market liquidity. So there's also an aspect of this being an improving story as the market grows. While those may be initiatives that are starting in a pocket of private markets, there's should hopefully be optimism that with technology and investment, a lot of the sunshine there will expand to other asset classes. I guess to answer the broad question, though, Jana, I think there are rules that prevent so the sort of most direct conflict that you're describing, which would be sort of a private fund managed by an asset manager like Apollo selling a portfolio company to a retail registered 40 Act fund. Those conflict of interest rules are still in effect. Where most investors are actually consuming and investing in private assets, not directly into a portfolio company, but through a regulated product that faces important safeguards on the conflicts of interest, important requirements around disclosure, around what types of fees that can be charged. So I think as we step back and think about, again, the trade-offs, but also the potential benefits that are available if people are provided access through controlled environments like regulated funds. The market has shown that there's significant demand with 60 billion plus raised in these regulated products year to date, and a growing expectation that the evergreen regulated product space will continue to grow.
Ben mentioned the problem of liquidity in private markets, and kind of to be nicer to you and be a little easier on Apollo, I'll say that Apollo actually has been actively participating in creating liquidity in private markets, right?
Yes.
Private credit ETFs, one example. Actually taking investment grade to private credit and creating secondary market, right, for those people who can hold the credit for longer and have a premium for that holding period. That's a way of creating secondary market, right? So ultimately what I would argue is that firms like Apollo create solutions, liquidity solutions in private markets, and should be encouraged to innovate and essentially resolve the problem that Ben is highlighting to us.
I agree, and I think the secondary market liquidity is a natural byproduct of the growth of the overall private market space. It goes beyond Apollo. There are a number of the bank broker-dealers are also focused on making markets here. When you think about the type of sticking with investment grade credit, there are known borrowers that are going to the private marketplace to solve oftentimes customized financing needs. And when the opportunity comes along for secondary market liquidity, we're finding that there is a cohort of buyers that can underwrite that investment opportunity, and that the market can trade with the orderliness and reasonableness that then allows for confidence in the secondary market. And that's so critical, because as you think about with growing secondary market liquidity with transparency, now there's an opportunity to include private assets starting there within a larger subset of client portfolios. And once they're in things like ETFs, they can then be doing the same work to improve outcomes for a broader retail audience.
Okay, well, let's move. I think we made a good argument in favor and against, but let's move to the next section and talk about what is the current legal and regulatory infrastructure that actually allows for retail capital to already flow into alternative asset management. So I'm going to go with two lawyers. William, do you mind starting us on this?
Sure, yeah. So the foundational statutes regulating U.S. capital markets today were enacted by Congress during the Great Depression era in response to widespread market abuses that I think everyone in the room is probably familiar with. And those regulations apply at three different levels. One is at the level of the issuer that's issuing securities. One's at the level of the investment company making investments in issuers. And one's at the level of the individuals and institutions providing investment advice in the Investment Advisors Act 1940. So at the issuer level regulation in the Securities Act of 1933 and the Securities Exchange Act of 1934 came on the heels of dramatic expansion in securities offerings and speculative investment in the 1920s. And that period was characterized by inadequate disclosures, market manipulation, insider trading. There was lots of problematic stuff happening in the market. And so in the 1933 Act, Congress responded by requiring that all securities offerings be registered and that issuers provide investors with this extensive disclosures related to the offering, including audited financial statements of the issuer, and impose strict liability for material misstatements and omissions, and created broad anti-fraud liability. In the 1934 Act, Congress regulated the secondary market for securities issued by issuers. This included market manipulation prohibitions, insider trading restrictions, margin regulation, also imposed periodic extensive reporting requirements on issuers to keep investors informed of developments in the company. So at the issuer level, the 1933 Act, 1934 Acts ushered in a new era of market transparency, and this helped to level the playing field between sophisticated and unsophisticated investors by improving price discovery and eliminating information asymmetries, as Ben and I sort of alluded to before. And in effect, what these laws did was present companies with a simple bargain. If they wanted to access the largest pool of capital, i.e. the general public, and provide their investors with liquidity, they had to assume the obligation to disclose substantial amounts of information about themselves. And that's proven to be incredibly useful over the years. In addition to leveling the playing field, as we've talked about, and eventually providing a path to easy diversification through indexing, having these disclosures available to the public has provided the public with a wealth of information that's been very helpful to inform decision-making at all levels of society, including in the efficient allocation of capital. Also, maybe less intuitively, it's also helped to lower the cost of capital in private markets by providing market pricing information for comparable firms. So there's sort of some free riding happening in the private market on data generated in the public markets. So there's substantial positive externalities that's been generated by the 1933 Act and 1934 Acts, and for most of their history, securities laws were structured so companies effectively had to go public if they wanted to grow beyond a certain point, because the public markets were the only source of sufficient capital. So that has changed over time. There was this sort of bargain that's changed over time. Starting in the 1980s, many of the most significant restrictions on raising private capital and trading private securities were diminished or eliminated altogether. So the conversation we're having today is a continuation of a conversation that's been happening for a long time. So these included the enactment of Reg D in 1982, the adoption of Rule 144A by the SEC in 1990, the enactment of the Jobs Act in 2012, which did a lot. All of these were really important steps in making it easier to raise private capital, and then amendments in 2020 that raised existing limits on the timing and size of private offerings. The list kind of goes on. And in effect, these changes together made it so issuers could choose whether to go public or stay private. And when given a choice between public registration, which has become increasingly burdensome in the wake of Sarbanes-Oxley and Dodd-Frank, companies increasingly chose to opt out. A professor at Duke Law School, Elizabeth de Fontenay, described this as an unstable equilibrium, where public market regulation got more onerous and private market capital raising got easier, and predictably led to more companies choosing to stay private and avoid public registration. So that in sort of setting that up, it leads me to one observation, which is one of the arguments that we've heard being advanced for opening retail markets to private markets. Even further is simply that private markets have already gotten so big, it seems unfair to keep retail investors out of such a large swath of the economy. But I think this argument suffers from some endogeneity, since one of the reasons we're in this place is precisely because of repeated decisions that we've made along the way to relax the regulatory structure. Here we are, sort of having this conversation again. So that's at the 1933 Act and 1934 Act level. There's also regulation, foundational regulation at the investment company level. And I think most of what we're discussing as it pertains to pooled investment in private assets is dealing with the Investment Company Act of 1940. So the Investment Company Act of 1940 followed a 5-year investigation in the 1930s where the agency found widespread abuses and conflicts of interest, not at the issuer level, but at the level of investment companies, including self-dealing where managers purchased securities from affiliated companies at inflated prices, sold fund assets to related entities at below market rates. And they also found excessive fees and hidden fees, inadequate disclosures, et cetera. So to address these concerns in the 1940 Act, Congress established a number of structural protections. So going beyond what you found in the 33 Act and 34 Act, the 40 Act is structurally sort of prescribes the way that the market, or the way that these vehicles need to be built. And so that includes prohibitions on affiliated transactions, leverage limitations, limits on excessive fees, and a prohibition on performance compensation, extensive standardized disclosures, and a requirement for daily liquidity, mandatory boards with independent directors, very prescriptive. So with the Investment Company Act, we sort of saw similar, exemptions were brought into the 33 Act and 34 Act. We saw exemptions that were broadened with the Investment Company Act as well, with the passage of 3C7 in 1996, which Barry Barbash referred to earlier today. And another change that sort of expanded the pool of capital available to private company issuers was the SEC decision to increase the limit on illiquid holdings in registered mutual funds from 10% to 15%. So these are sort of the foundational statutes. I think in both of them you see maybe just two themes. One, they started in one place and the exemptions have grown and grown and grown, and private access, it's made it much easier for companies to access private capital while increasing, while at the same time we've seen sort of public companies having an increased burden of disclosure obligations. And I'll also just note that just because a fund is a registered fund, it doesn't guarantee it's going to be a great option for investors. We heard in the prior panel commentary about ETFs. Essentially everyone, this is sort of throwing noodles on the wall, right? And everyone launches. And so I guess I would say that, the gold standard is passively managed index funds. And just because something's passes the 40 Act doesn't necessarily mean it's going to be a great investment option for investors. So those are sort of some of the foundational statutes. I'll maybe hand it over to James, who can talk about options available to private fund sponsors who want to raise private capital from retail sources.
Sure. And, I think, I was actually just thinking about the gold standard there, as Will, you articulated it with, passively managed index products. I think the challenge there is just the concentration within a lot of those indexes, as has been discussed throughout today. So, the broad premise of these products has been to give people exposure to diversifying exposures, private market exposures. There's a bit of an alphabet soup of the different wrapper types, but if you kind of step back and recognize that, largely a lot of them are being consumed by individual investors. Some of the key characteristics, sort of become intuitive. Number one, whereas an institution is investing for 10, 20 years, there is, in an individual setting, a reality of life events require people to have access to their capital. So generally these are semi-liquid products, right, in the spectrum from daily liquid mutual funds on the one hand versus the legacy term vehicles that institutions and ultra high net worth investors have consumed. These are filling a gap in the middle. It's not a complete portfolio solution, but for investors that have a bucket within their savings for medium-term savings, they can invest and capture some of the private market premium through these vehicles that may offer something like a quarterly redemption right, subject to a 5% limit. The second reality of dealing with individuals is that something like a capital call or ready access to capital that is common for those drawdown vehicles is not consistent with the individual experience, and people really can find it challenging to be sending in capital checks every single quarter. So oftentimes these are fully funded, and tying those two concepts together. So people invest in full upfront. There's an ability to redeem at the quarter end. What does the portfolio ultimately look like? Generally, the 80-20 rule applies. So there's about 80% invested in of the total that's invested in private markets, and about 20% that's kept in liquid securities to be able to support that 5% per quarter of redemption commitment. So liquidity and is a common hallmark. Then as you move from there to think about that alphabet soup and adapting that broad goal to individual strategies, it can be fact specific. So we've mentioned REITs. So those are for of course real estate. We have BDCs where there are requirements as to asset eligibility that require at least 70% of the portfolio to be invested in private companies or U.S. private companies or small market cap companies. Clearly, if your strategy doesn't involve real estate or doesn't, is global in nature, those wrappers won't work for you. The most flexible of the wrappers are actually in terms of asset eligibility and portfolio composition would actually be the interval funds and tender offer funds that contain all of the different protections of the 40 Act that Will walked through earlier. Governance constraints, leverage constraints, requirements around disclosures and fees. And as we're seeing a diversification of different strategies being brought through that wrapper, again, think that we can take comfort in the regulatory environment. And certainly, while we're not throwing spaghetti against the wall, but I do think there's a recognition that these products are not necessarily guaranteeing outcomes, but in a framework where there's full disclosure and choice of the strategy and of the risk, the innovation and the range of strategies that are being made available feels like a healthy system. I'll maybe just mention one more, Jana, since you had asked us to cover this, operating companies, holding companies. We've spoken about credit, real estate, and interval funds, tender offer funds which are oftentimes used for minority investments in equity. What's left over? Control equity. If a strategy involves owning and operating businesses or assets, the investment company, wrapper may actually not be the right one for your strategy because, that's principally meant to regulate vehicles that are trading securities. So if you are owning, a business and controlling it, a conglomerate or holding company structure might make more sense. And, the seminal example of that would be Berkshire Hathaway, where, through that company, they are owning and operating a range of different, businesses, and when one buys a share of Berkshire Hathaway, they're getting exposed to all of those. So, that is, starting to be seen as well within the mix of products. But again, just would, probably end with acknowledging, optimistically that there are, I think I wrote down within just the interval and tender offer space, there's 286 products out there from 150 different sponsors, pursuing a wide range of different strategies. To think that the 85-year-old statute has facilitated, that type of, innovation, it's through thoughtfulness around the interval fund rule in the early 90s, and it's been through the thoughtfulness of providing exemptive relief when the underlying public policy concerns may not be present. So what is as we look forward and think about the products that may be still to come, the relief that may still be to come. It's building, it's incremental on top of that legacy of facilitating capital formation. Again, certainly do not deny the nuance, as Mark mentioned, and the trade-offs that Will and Ben have acknowledged. But if we're thinking about a 60-40 portfolio, right, which is intending to bring diversification within the 60 and within the 40, there may well be similarly an opportunity for a mix of public and private assets to enhance overall outcomes.
But I want to bring you back into the discussion because William gave us a very good evolution of a regulatory framework from really 2014 onward, when private equity started to get a lot more regulated. And then, James, you just told us that, well, there's quite a few vehicles out there, but nobody guarantees an outcome. So can I go back to the argument that you made recently in your paper where you said, well, why open retail markets? Why open more private markets? Why not go back and fix public market?
Yeah, I think that a little bit this discussion seems like a solution in search of a problem. If the private markets are having a cash crunch, it's not really up to retail investors to solve that. I think that a lot of the arguments that are made are we've made the private markets so big that we have to let retail investors participate in them. When I think what we should be doing is realizing that we've got it backwards. It's supposed to be that everything, the equal opportunities exist in the public markets, right? The public markets are supposed to be for everybody. That's where retail investors get their protection, so that's where all the opportunities should be. And instead, we've allowed these exemptions to proliferate to the point where it's like, well, now all the good stuff is in the private market, so shouldn't retail investors be there too? If we allow retail investors to, be in the private markets, like that's going to be the whole market. There's not going to be, any space for there to be this, oh, well, these are private offerings that are only available to accredited investors, but really you have everybody else in the public markets. You're just going to have one big market and it's going to be private, which is the opposite, I think, of what the foundational securities laws that Will was talking about is supposed to get at. So what we need to do, I think, is not focus on continually expanding the private markets, it's to revitalize the public markets. So we're not in this situation where we just kind of have to, say retail investors need to get into the private market so they have the same opportunities as everybody else. I think there's oftentimes a lot of discussion of, oh, well, it's really burdensome to be in the public markets and that's the problem, and so we need to allow greater access to the private markets. Well, I mean, is it burdensome? It's providing disclosure to investors. You have to remember, like, this is asking regular people to give their money to somebody else. Their money that in a lot of respects is for their savings, for their retirement. I don't think it's unreasonable to suggest that when you're doing that, you should have disclosure. Is that a little bit more costly? Yes, it is, but that's why we have the system that we have. And so should we find ways to make it easier to go public? Yes, we should. But I think we need to focus on doing exactly that and revitalizing the public markets and not just continually expanding the private markets.
If I could just jump in with one thought on that. Former Director Champ this morning talked about the need to make it more attractive for companies to go public. But I think it's interesting to be at the same time thinking about expanding access to private equity. It feels a little bit like, to analogize to a house is on fire, and you've got one team that's spraying the house with a fire hose, and another, on one hand, trying to put it out, and then another team coming and spraying it with gasoline. It feels like they're sort of working at cross purposes with each other, where if we're expanding private markets so aggressively, that may outweigh any effect of trying to make going public more attractive.
Can I jump in on that? I mean, there's so many aspects here that are complex, that they seem like they're competing with each other. But I think a key point, as I was thinking about these topics, is it's a lot of cases it's not an either or. Maybe it's a both. I think if you make one market more attractive, that should take capital away from another market, because at the end of the day, this is all about businesses saying, where am I going to get my capital? And then investors saying, where can I invest? And I think you can accomplish both. You can make private markets more efficient, more transparent, and public markets, you can make them a better environment for companies to raise their capital. And so the aspects, if you compete on both ends, most markets will find the right balancing point. And I think where we are today, it's been clear throughout this conference that it feels like it's a little imbalanced. And that's been the result of, again, the last 25 years, public company decline, number of public companies declining by 40%. So we acknowledge that there's some kind of imbalance, and I don't disagree, Ben. There is an opportunity in public markets to make that better. What does that mean? That's going to come through a lot of discussion. And as Norman said this morning, maybe it's disclosure, but not having disclosed on all these different things. Maybe we've gone too far on that. That's something far out of my expertise, but something to discuss. We acknowledge on the surface that there's an imbalance. But kind of coming back, like living in the today world, and as opposed to saying, if we started over, could this be? How do we go forward? The giving retail access to private markets, when we take a step back, we have to understand that private markets are fundamentally different than public markets in so many ways. But the way I think about this, I think it simplifies it, is public markets in a lot of ways, you can facilitate direct access to investments. You can invest in a specific company, equity or debt, in a very efficient manner now. It wasn't always that way, but we've gotten there where we are today. In private markets, it's very much an intermediated exchange. You cannot go buy any private company that you want. That's the point, they're private. And so the institutions that hold the vast majority of private markets assets, they're working with intermediaries, whether they're GP sponsors or whether they're consultants and allocators and such, that do all that work. And so, again, I don't think it's an either or here, where if you're investing in private companies, there is no financials and there is no disclosure and there is no oversight. Far from it. Actually, from what I've seen, the most institutional investors, the most sophisticated, have all of those in place to where they are looking at those companies. They do have really good financials, and they're seeing that and maintaining a good degree of oversight. And so again, it's the particulars here in that I wouldn't look at private markets as, oh, they're all this way and all public markets are all this way. It's a continuum. Are there some private companies that don't have good financials and don't have good disclosures? And should those be broadly given access to general retail? I don't think anyone's saying that. I think it's about increasingly going down this path and being able to intermediate access of private companies to retail investors. I think, as James was saying, that's where the product structure comes in. So just some of those things, I mean, there's a lot of topics that were discussed here, but I think it's just have to take a step back and see where are we today versus where could we go, and knowing that you have to kind of live in a progressive world where we are today, but with the oversight of, hey, maybe we can make some changes and shift this direction. And maybe the last one, sorry, I've been writing my notes. When the aspect of these services around private markets and people essentially kind of, I think, feeding off that trough of the inefficiency. It's hard to do work here. So the lawyers and all these different people, they're profiting from that. And it's a factual statement, but I think that's more so the more capital that comes into the private markets in through the retail channel, through more of the oversight mechanisms that James was talking about, because these vehicles that invest in private funds that are registered, and they do go through the intermediaries there, it is drawing more efficiencies. But I agree, as my day job as a research analyst, I don't want it to be that way. I don't want to spend a ton of my time trying to get information on these funds and on these companies. I would like to have more information and make it easier, or focus on where I believe there's true alpha in the decision-making process. So I see from my seat that the public market, and especially the retail side where they're used to that, is pushing the private markets to operate more efficiently and to drive more transparency and to get the data. I think what we've seen in the last few years, the acquisitions by multiple firms, they've realized that private markets data is very important to every single part of the process. And that is just going to continue to push. And now that you have players like BlackRock buying Preqin and saying, okay, what can we do with this data? It's going to push these markets closer together. And so you have all these factors coming in. But I just wanted to say that because how it's been operating the last 30, 40 years, if we continue to operate like that, that would be incredibly frustrating. And that we will see progress.
Wow, I have to find a bridge in this, right, somehow. When you talk about private data, I work for a company that for the last 30 years focused on nothing but collecting and structuring private data, whether it's private companies' data, whether it's private credit. And I can tell you that we have 600 people devoted to it day in and day out. How retail and sophisticated investor would get access to that data, it comes at a huge premium, right? I know because I charge subscriptions. And how they would interpret that, right? That there's another layer of lack of sophistication with retail investors. Even some of the institutional investors. That gap, that educational gap, is going to take a very long time to fill. But what I wanted to do is bring it to today, because we do have a new chair in Securities and Exchange Commission, Paul Atkins, and he came out recently at PLI conference, and he gave his vision for Securities and Exchange Commission. He was very much focused on innovation. He was very much focused on creating new sources of capital, democratizing retail market, democratizing private market. And we're already starting to see how this administration and this chairman is willing to push the boundaries a little bit to allow a lot more retail flow into private markets. Recently, I'm sure you all saw non-action letter that was issued by Securities and Exchange Commission in response to Latham Watkins' request on providing guidance on investor qualification, right? And right there, SEC allowed for a change of definition of qualified investor, which tells me that there's a baby step being made in at least one direction, right? We're not addressing public markets, but I can see tiny baby steps in trying to attract more retail money into private markets. What do you think is the impact of that? new, I mean, Ben, it looks like, Ben, you would like to take this. What do you think is the impact of that? What do you think of the new philosophy and I guess new approach to private markets that's coming with Paul Atkins?
Makes me a little worried. I thought the no action letter was interesting because it, pretty much says that you can allow investors to self-certify that they're accredited investors, which I think poses a number of problems. But what I found most interesting is that seems pretty contrary to what the SEC said in its rule imposing the verification standards. There was language in that adopting release that said verification shouldn't be done by just having investors, check a box to certify. And so the no action letter seems to pretty much contradict that, the text of the rule. So that's troubling in its own right, but then also, like you're talking about the trend, I'm just worried that if we're going to continually make it easier and easier for retail investors that really can fend for themselves to be considered as accredited investors that, can or are supposed to be able to fend for themselves and therefore don't get the full protection of the federal securities laws, it's really going to endanger retail investors.
Just maybe to present a slightly different take on that. 506C established the concept of a private placement with general solicitation and agreed, of course, it allowed for an expected enhanced due diligence. It then created a safe harbor with, for example, but the four examples were not thought to be terribly practical in the context of how products are sold through distributors. One was you could look at somebody's tax return. Another would be you could get a letter from their CPA. So, I think what the no action letter was trying to do was to, create yet another way in which enhanced due diligence potentially could be satisfied. And in this case, they use the investment minimum. If we're ultimately trying to figure out, does somebody qualify either under the income or net worth standards, do they have $1 million net worth? Well, if they're putting in $200,000 into a particular investment, that's probably, some degree of evidence that they have, would satisfy that requirement. And so while it's not necessarily perfect, I think it is a bit more than just self-certification. It does have conditions and constraints that seem to be, again, trying to, consistent with the intention of 506C and Congress's and what they were trying to provide.
Another positive sign, although Ben would argue with me that it's not necessarily positive, but another sign of bringing innovation and allowing retail capital to flow into private markets is the lift of the 23-year-old rule on the 15% cap on funds. What do we think it means long-term and how it actually, because it's registered funds, right? So you have some level of security and some level of transparency. So is that a better way to allow for individual investors to enjoy benefits of private markets? Ben, Mark, anyone?
Well, yeah. I'll just say quickly that, we'll see. I think that in that same speech in which he talked about lifting that restriction, he talked a lot about why he wants to do it. And then at the very end, he said, of course, we have to deal with the conflicts of interest and liquidity and problems like that that exist in the private market. And so we'll see, right? We'll see, if they really do take those concerns to heart.
Yeah, and I think here as well, there is the byproduct of this in part is, lowering the suitability standard from accredited to pure retail. It is also, though, removing a subdoc in the subscription process. And so, some of the industry excitement is less about, now we can sell to a wider audience, but more just that the purchase process will be easier. We'll be able to potentially offer certain strategies with the efficiency of interval funds that, trade like a mutual fund with a 5-letter ticker symbol. I think the fact that, sort of contrary to the last issue where there was a congressional intent, in this case, it wasn't quite clear where that policy came from. It was these are registered offerings, so under the 33 Act, there is no requirement, and in fact, it was, more just the policy that issuers were, voluntarily adopting in order to get approval. So, the notion of removing that constraint certainly does require, again, continue to require the thoughtfulness around the balance between capital formation and investor protection, but also may just be, applying the law as written.
And maybe just another aspect is, again, level playing field. We're talking about private markets. We're not talking about being able to buy individual private companies. That's not the function. It's not possible. So we're talking about intermediated products, given that to retail, just like that's the way institutions have accessed private markets. But already in the public markets, there's a tremendous host of products that span the spectrum of, to your point, I would say quality. And the prior panel talked about ETFs, how many are launched and closed every year, how many people understand the leverage, how the leverage is constructed, and what that really means to returns in these ETFs that are launched. Again, not my area of expertise, but I would assume if you look at that the general retail investor does not know how to understand the leverage that goes into them. So I think when we think about investor protection, and sometimes unfairly, private markets get classified as the riskiest Wild West of the asset capital markets, and I don't think that's a fair representation when you think about how you're actually getting access. What are you actually getting versus what people can get in the public markets? Because while disclosure is good, I will always support disclosure. Disclosure does not prevent investment loss. There's plenty of examples of public companies that go bust, and every retail investor has access to those and can buy them individually on their app very, very quickly. And so I think there's, again, just like most of these, there's a good balancing point. And if someone gives you a really simple conclusion, they're probably missing something.
A good example, BDCs recently run into a little bit of a negative publicity where I think academia actually made an argument that banks lending to BDCs are increasing exposure for banks. Effectively, the argument was that using retail deposits to lend to private vehicles to do riskier credit lending. But if you look at the actual data, it was very clear that BDCs were holding loans that were of very low delinquency, that credits were extremely healthy, and there is a sophistication sitting within BDCs to know exactly what would be invested in. And so the note that Federal Reserve put out said that we don't actually see a problem with that. When we see a problem long term, as the private market is growing, we don't like the interconnectedness between banks and BDC, as long as the market continues to expand. But ultimately, once you get to data, you have to understand that the investors are sophisticated enough, and they do so much work to understand what private assets they're buying into, right? That you have to, in some way, believe in the efficiency of the market, right?
So I think the point about intermediation is a really important one, and this is a very different thing than saying we're going to provide investors with access, to invest directly in companies. But as I think about the research on fund of funds, it's not super. It doesn't make me super optimistic that intermediation, adding another sort of layer of, I think the quality of the intermediation and the price at which you get it is ultimately going to matter a lot. And I don't know if retail investors are in the best position to make those judgments on either point. It's an open question.
Well, we have 1 minute to go, so we have to do a lightning round. And to finish up, can I ask each of you gentlemen to, Paul Atkins is obviously listening to this panel, and he's thinking about it a lot and taking notes. What advice would you give him as he is looking at the issue of retail investors actually having access to private assets? What should he be thinking about, and perhaps what we haven't raised as an issue at this panel? But you really are talking to Paul Atkins right now. So what would you tell him in I don't know 30 seconds or less? Go. I mean, if we're overrun, it's okay. John, is that okay? Thank you.
Well, I would just say, there's always a lot of talk about the SEC's tripartite mission, and sometimes you hear that there's too much emphasis on investor protection and not enough on capital formation and fair and efficient markets. But now it seems there's a lot of emphasis being placed on capital formation, and I would just urge Chair Atkins, who I'm sure is listening, to make sure that investor protection doesn't get lost in that.
Thank you, Ben.
I feel like that's a question that should have been given before, so we actually think about it. I like it. Well done, well done.
30 seconds. Twitter like, short, and type.
Move forward, but be thoughtful. There's opportunities abound to enhance the public markets and enhance the private markets, but it's incredibly complex. And so you have to move forward, but be thoughtful.
I think I would just, encourage what has already been said, which is the receptivity of the staff for industry of all sides to be approaching with questions, interpretive questions, ideas for exemptive relief. I really think that we are all aligned in wanting that tripartite, mandate to be honored, and in the face of evolving markets and evolving investor preferences, having access and a partnership with the regulator is critical.
And I would just say any solutions here, steps forward, need to be thought of in a comprehensive way, thinking of the impact not just on private markets, but public markets as well. Maybe thinking that, the urgency around getting retail investors into private markets and the benefits that proposes may not be as urgent as needing to fix our public markets.
Very good. Well, I thank you all for participating in this panel. Ben, Mark, James, William, thank you so much, and thank you for listening.
I want to just add my thank you to the panelists. I'm just going to take a couple minutes for closing remarks. First of all, thank you, Yana, and to the rest of the panel. I will be sure to share your advice with the chairman when I meet with him next, and I appreciate your thoughtful discussion on what is front and center for our division and the agency. But that your panel today was just one of many panels that were thought-provoking and really had fantastic discussions. As I mentioned this morning, I want to underscore here as well my heartfelt appreciation to all the panelists for traveling to the headquarters in DC today to share their lessons learned and share their varied perspectives on each of the various panels. We here in the division, as I'm sure you too, will have our eyes on the emerging trends discussed today and in the next coming weeks and months and years. I began this morning commemorating the 85th anniversary of the Investment Company Act and the Investment Advisors Act, two statutes that have stood the test of time, protecting investors and stabilizing markets. And in the face of those trends in the asset management industry that have emerged over the past 85 years, I will likewise conclude today's conference by expressing my confidence in the structural and regulatory protections those statutes offer as we consider the emerging trends of today, tomorrow, and of the next 85 years. I thank you all for attending virtually and in person today's conference on emerging trends in asset management and look forward to continuing the dialogue outside of this conference. Thank you.